Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we looked at the XLF. That is an ETF that tracks the financial sector. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at the XLF. And the theme for the last few stock plays of the day have been option strategies that may be able to enhance your stock portfolio. So the trade that we looked at on Tuesday was a cash secured put. Now, I'm showing the cash secured put inside the options playbook. And on Tuesday, the market environment was a lot different than we find it today. Everybody was nervous. The sky was falling. Whoa, my Lord, what are we going to do? It just seems to be a little bit about the seasonality of the September and October timeframe. See a little bit more over the years. We've seen a little bit more volatility in these 2 months in particular. There's never really been a reason as to why that is. It just always seems to happen. Everybody was a little bit nervous. So we talked a little bit about having some sectors that have been down a little bit that you might want to look at ETFs in, but you're a little bit worried about that concept of catching a falling knife. So where you could target a downside, be willing to buy 100 shares of that underlying stock or ETF in this case, and then hopefully be able to remain long that underlying stock going forward. And that's what the options playbook is showing you inside that profit and loss graph. Now, this is called a cash secured put, and we treat this much differently inside the options playbook as opposed to a short put or a naked put, where you're just selling the put, hoping that it expires and that you capture that premium. This is a much different concept. So if we look at this cash secured put, what we're saying is, we sell strike A. It's usually below the market. The stock is usually somewhere up here on the profit and loss graph, saying that we'd be willing to buy, and we have the capital to buy the underlying stock if it goes down below strike A and the stock is put to us. Then after that happens, our profit and loss graph becomes long stock at that strike price minus the premium received. That's basically where your cost basis would be on that underlying stock. Now, as always on the stock play of the day, when we're looking at these strategies, they're not meant to be a recommendation. And we've talked about this on the last two shows, that if you had a sector that you were targeting, this is one way that you can do it. You can decide what sector you might want to target. We also looked at protective strategies on stocks that you may have had a gain on. We looked at a covered call in Apple, also looked at a protective put in Apple going into year end. Then we combined the two, looked at a collar. So those were a couple of the shows that we've done the last few weeks on the stock play of the day. So let's look and see what happened in the XLF this week. So if I run to the Ally Invest chart here, we see that this is the XLF. It's at 38.28, up a little bit today. Markets are flat to a little bit down overall. This is a 15-minute chart. So these bars are 15 minutes. We always tape live at noon on Tuesdays. That means we're dealing with real markets while we're taping the show. And we see at noon, this is about where the stock was at, around 36.75. So for the rest of the day on Tuesday, the market traded a little bit more down in the XLF and in the markets in general. We did have a strong rally, a little bit of a strong rally going into the close, a little bit of a bounce back, I should say, more than a strong rally. Then all day Wednesday, we were up a little. All day Thursday, up a little bit more. And now looks like we're up to about 38.29. All right, so this bodes a real good question. We sold the put. We were trying to buy the stock at a lower price. We did not buy that stock. It doesn't look like it right now as far as the market is concerned. So is this a good thing or a bad thing as far as our cash secured put is concerned? So let's look at what happened and what the trade was. We're up about 28 cents, like I mentioned, almost 1%. That's close. Not a bad day overall. We discussed a lot about the time frame that we were trying to target, as far as we didn't want to go out too far in time because there's a risk that the stock could go down and bounce all the way back, and we actually don't get assigned on our cash secured put. You'll usually get assigned a little bit closer to that expiration date overall, and we discussed that a little bit too on Tuesday's show. So we decided that we would go out to the October 8th expiration. We were going to sell a put a couple of points below where we were at. So we actually sold that October 8th expiration. Now it has 14 days remaining, and we sold it for 51 cents. That was a midpoint that we were looking at. So the maximum we could make on that trade would be $50 plus minus any commissions that we paid on that trade. And we have the risk of basically stock ownership. It's very similar to owning stock. You have substantial risk when we're talking about puts because the stock can't go below zero. So we always say substantial overall. And right now we see that option contract is trading for 10 cents by 11 cents. Real good markets in the XLF. We talked about that too, about one of the benefits of trading in an ETF that gets a lot of volume overall. And you could actually buy back this trade and close it out if you'd want to, and you would have approximately a 40-cent gain on just that short put. But that really wasn't our goal. Our hope was that the market would continue down in the XLF and we could actually buy it at a lower price than where it was currently trading on Tuesday. So on Tuesday, the market was at 36.76 is basically what I was seeing. Right now we're at 38.32, but we still have 14 days remaining. We're still in September and October. Market made a fairly strong move up, or bounce back, I should say, from the market conditions on Tuesday. Doesn't mean that it can't come back down. We might still get that opportunity to buy it. But I'll show you, because we always talk about alternative trades or what you can do on the stock play of the day over time. And as always, not meant to be a recommendation, just highlighting that. So if I have this position that I am short in my account, and I'm looking at the Ally Invest option strategy workbench, the XLF 36 strike put, if this was in my account and I was short and I wanted to close out that position, the way that we would do that is we'd click trade, run over to the order ticket, and instead of selling to open, which was the initial position, we would now be buying to close. We would be removing the risk of being short an option contract. And it would be the same strike and expiration, obviously. Right now, we have a midpoint of 11 cents and the ask is 11 cents. If I were to close it, I would probably just pay the ask because there's only 1 cent difference. So the ask is highlighted as a natural. As always, we talk about this most of the time when you're trading with options, you just want to put a limit order in, limiting the price that you would pay, even if we're going close to the market price like we would be here. So we'd be buying to close the October 8th 36 strike put at a limit price of 11 cents. And you would click preview order, and the order is not in the account, but basically that would be one way that we would enter this trade, close it, remove our risk, and then just move on and go to our next trade. Now, if we're doing it truly on a cash secured basis, which within Ally Invest, if you're approved for this type of trading, you can do cash secured put selling in retirement accounts like IRAs and Roth. But if you're doing it on a cash secured basis, you're saying that you have the capital in your account to buy that stock at that strike price, much the same if you were putting a limit order in. So we would need $3,600, which is the amount to buy 100 shares at $36. So by closing this, we would release that capital. That capital would be set aside in your account to buy the stock if it came down, because that's your risk. So you have to cover that risk overall. And if we do buy the closes, that capital gets freed up and I can go on and I can target a different trade overall. So right now the stock went up. We made money on our put, but you could say that our outlook was wrong because we really wanted it to come down and we wanted to be able to buy it at that lower price overall. So it's always nice when our outlook is wrong for the underlying stock, but we still are profitable on our option position because we were willing to take on an obligation. We were willing to sell an option, take on that obligation to buy. When you take on an obligation, a lot of times you bring in a credit into your account overall. So short and sweet, because the market went up this week. So there's really not an alternative trade to look at here. And that's going to be it for this episode of the Stock Play of the Day Overtime. If you please click subscribe, ring the bell. We'll be back next Tuesday for the Stock Play of the Day, and we'll see you then.